First of all, let's just kind of talk briefly about what a SPAC is, how it comes to be, and just kind of just a little bit of background. I know we've covered the basics of SPACs pretty frequently on this show, but generally, a SPAC stands for Special Purpose Acquisition Company. It's a company specifically formed for the purpose of merging with another business and taking it public. So a SPAC generally will a sponsor will decide to create a SPAC. The SPAC has to have a sponsor. This could be a company, it could be an individual investor, or they are an experienced investor, it could be a hedge fund. But so they'll issue a registration statement and kind of declare that they are taking a SPAC public. They'll hire underwriters, things like that. Go through the traditional IPO process just like any other company. The difference is a SPAC at the time it goes public has no business. It's just going public for the sake of raising some capital. So we've seen a few SPACs kind of hit the news lately because they are taking certain companies public. For example, one of Chamath's SPACs, IPOE, Social Capital, head of Sophia 5, we recently learned is taking SoFi, the fintech firm, public. So we spend a lot of time on these shows talking about business analysis. That's what Brian and I pretty much do. We tell you how to evaluate companies. We did a show on Square and Green Dot last week where we kind of walked through how we analyze some of those at a pretty high level. But the big question on a lot of investors' minds is, why the heck would you invest in a SPAC that doesn't have a business yet? You don't even know what you're buying. So that's a question I've gotten a lot. And the short answer is you're betting on management. You're betting on the SPAC sponsor's track record and their expertise to find a deal. Because when a SPAC goes well, it can be a great way to get involved in the IPO process, because a lot of individual investors are usually shut out of IPOs, myself included. I don't know who Brian uses, but I use TD Ameritrade. Brian, what brokerage do you use?
Fidelity.
Okay, Fidelity participates in a few more IPOs than TD Ameritrade does, but the general idea is unless your broker is directly participating in an IPO, you're usually shut out of the deal from an IPO. You have to wait till it trades on the market. So the SPAC model is meant to kind of level the playing field. So before we get going, Brian, do you invest in any SPACs on your own?
I don't, and I'm actually very excited about this show to sort of figure out whether that's something that I want to get involved with. I did have one question on your explanation before we sort of jump to the next step. Is once the SPAC gets registered, you said that it has no business, right? There's some kind of market value, right? Because it's raised money, but there's a period of time between when it's raised money and then it's trading on the market before it declares like it's going to do SoFi, right? There's sort of a couple phases here.
And that can actually be a long period of time in a lot of cases. In Chamath's SPACs, it really hasn't taken very long to find deals. But generally, these companies have up to 2 years to figure out who they're going to take public. So yeah, they go public. When a SPAC issues its IPO, it goes public. Usually the par value is $10 per share, per unit that it sells. We'll explain what the units and all that mean in a minute. But so it's sold to investors for $10 a unit, then it starts trading on the public markets. If you look at any pre-deal SPAC that's currently listed, it's not going to be trading for exactly $10. In most cases, you'll see a bit of a premium. If you type in one of the one we're going to go over in detail in a minute is Chamath's other SPAC, IPOD. If you put that in your quote tool, you'll see that it's trading for a big premium to $10 per unit. So the reason for that is if a manager has established a great track record like he has, the expectation is that he's going to create shareholder value by taking a company public. With most SPACs, the difference between $10 and the current trading price is a complete reflection of how the market expects the deal to go.
you.